Welcome back to another edition of Mining Metrics. My name is Jarrett. I'm here with Compass Mining. And as always, I'm joined with Kaan from Luxor. I actually am recording this from Colombia, and Kaan is over in Cyprus. So this is a totally international recording. We are here today. Kaan and I basically came together and we put together Mining Metrics to provide people who are into Bitcoin mining with metrics. So we're going to dive into that. I'm going to basically pass the mic to Kaan. But before I do, Kaan, how are you doing? How's life?
Doing well, Jarrett. Life is great. Having a ton of fun back home in Cyprus, visiting family and friends, and ready to dive into this session, checking out mining metrics for December.
Sweet. And just a note, Kaan is in Cyprus, and we may or may not have internet snafus, troubles. If we do, the show goes on. We will just continue to push through, because the great thing is there's a presentation, so there's a lot of visuals, which I'm always really excited about. So with no further ado, I'm going to go ahead and bring up the presentation. And Kaan, please, let's go.
All right, let's do it. Mining metrics, December 2024. So agenda for this session, first we'll go over an executive summary, a TLDR. Then we'll take a look at mining economics. We'll go over to the hardware section, do some analysis on ASICs, take a look at public markets, see how Bitcoin mining is doing in the pubco space, and then finish off with the forward hash rate markets analysis. So TLDR.
Christmas came early. I wonder what that has, like, I couldn't imagine what that has to be.
That's right. Christmas came early, and we'll definitely dive into why that is the case. The hash price environment is also getting healthier. Paybacks for ASICs have improved. Certain models are in demand, and we'll take a look into why this is the case. Interestingly, mining markets are lagging behind Bitcoin price action. Pubcos are also tapping into capital markets in new ways. Expectations on Bitcoin price and global network hash rate continue to increase. And then finally, the forward hash price is a better predictor versus spot hash price when we compare actual settlements for hash price. And we'll take a look into why that is the case as well. So starting off with mining economics. As we all know, December was a very interesting month for Bitcoin. As you can see in this chart, here we have average numbers throughout each month over the past few months, starting from September all the way to today in December, which is the 18th. And all across the board, we can see a lot of green, except for network difficulty, which is actually denoted in red when it increases. So which also means that network difficulty is on an uptrend as well. So taking a look at our first metric, the USD hash price, throughout the month of December up until today, hash prices averaged at around $62 per petahash per second per day. Compared to November, which had an average of $55 throughout the whole month, this is over a 10% increase. What this means for mining companies is that the economics are getting better, they're generating more revenue, and they have more room to breathe. So mining economics are improving month to month. And we can see this trend throughout the previous months as well. Since October, we've been on a pretty good uptrend, moving at double digits for hash rate, which is a significant improvement in month-to-month profitability for mining companies. Second is Bitcoin price. Obviously, this is a big news headline, not just for the Bitcoin and the mining community, but all over the world right now. And the reason, we'll get into why, is as you can see, Jarrett, throughout the past few months, Bitcoin has been on an absolute tear. Throughout November, we averaged a price of around $86,000, which was over a 30% increase compared to October. And so far in December, we've had a price that is hovering just under 100,000 on average at $99,000. Network difficulty is also increasing ever more. It continues to increase. Mining has never been as difficult as it is right now. So far in December, the average difficulty that we're seeing is 104.05 trillion. which is around a 3% increase from the previous month of November. And as you can see, throughout the past few months, we've seen consistent increases. Now, transaction fees tend to come and go. Transactions fees are very volatile and highly unpredictable. We can see how this plays out in this chart here. For example, in October, we had a pretty good month. There was a lot of non-standard activity around Bitcoin, for example, through meta protocols, through runes mints, these types of non-financial transaction related use and demand of block space. But this somewhat waned throughout November and has only slightly marginally increased in December. So we'll see how transaction fees play into hash price and mining economics, but safe to say that they're highly volatile and unpredictable.
I just want to call out there. I think it's really good for people to know that that Bitcoin price is the monthly average that you've taken, because some people will look at that today and be like, come on, man, we just hit 108 like 24 hours ago, in USD price. So that's good to know that that is the average. And I love to see that. And yeah, November was a very exciting time. I say that it was the mining metrics show that actually pumped Bitcoin. I don't know if there's any proof out there to do that. I also want to call this out. This is the end of the year. I'm feeling good. We're going to share this comment. I find this comment to be rather funny. The guy, good guy biker said, "What's with the unfinished basements?" Well, I'll tell you, good guy biker. Kaan and I are both on the road, and we're both kind of traveling as it is holiday time. So that's we're not in our home forts, if that makes sense. So yeah. Anyways, Kaan, back to you.
Absolutely. We'll see. We'll see Biker Guy next month in our finished basements.
Exactly.
All right. So moving on. December in a nutshell. Just like you said, Jarrett, you're right. The previous number that we saw for Bitcoin price is the average throughout the month of December so far. So month to date from the 1st to the 18th. However, you and I both know, as does the rest of the world, that Bitcoin hit a psychologically significant milestone, and that is the $100,000 price tag. On December 4th, Bitcoin hit $100,000. And in my opinion, this represents a momentous milestone because of the fact that it's such a nice round number and goes to show the level of resiliency and success Bitcoin has had as an economic and societal experiment. At this stage, I feel like we've entered a new era in Bitcoin, where not only is it widely understood as a financial phenomenon, but also it's becoming understood as a disruptor in energy markets as well. So I do want to take a moment to embrace this moment and to celebrate with the Bitcoin community and also the professional services industry around Bitcoin, and basically say, this was a psychologically significant milestone, which we've now been able to hit.
Yeah, it was a big moment. I think on some of the podcasts we've done here at Compass, we've mentioned it. Every guest that has come on, this is the first time you and I have connected, at least publicly, to kind of share this. But it's not something we should let go lightly, because when you add the next zero, we're at 1 million, and then that's something that then I think no one can deny. It's funny, even at 100K, I've heard a lot. I've heard enough people, in my own orbit with FUD, as I've heard the similar amount of people who have been like, okay, how do I get into this now? I'm finally ready to listen. So it's interesting how adding 1 0 can kind of change things. But as I said, when we add the next zero, we're going to be at 1 million. So it's exciting. It's exciting for the community, exciting for the space, and definitely exciting for the Bitcoin mining industry.
Absolutely. So now let's get into the rest of the metrics. What's most important for miners beyond Bitcoin price? So taking a look, we've already talked about Bitcoin price. We know that it's on an absolute tear over the past few months. It's been going up and up and up. We've recently hit the 100,000 milestone on December 4. And just like you mentioned, yesterday on December 17, we just marked a new all-time high of just over $108,000 US. At the same time, we can see how difficulty is increasing as well. Coincidentally, at $108,000 Bitcoin, network difficulty is at 108 trillion. And this, I think, is quite funny, but it goes to show that as Bitcoin becomes more popular and more in demand, mining is becoming ever more competitive. Like I said, it's never been harder to mine Bitcoin than it is right now. So the next constituent which forms mining economics and hash price is transaction fees. Like I mentioned, transaction fees tend to come and go. They're highly volatile. And this picture sums it up quite nicely. What we're looking at here is the transaction fee as a percentage of the overall block reward, which takes into account the block subsidy, which we know is 3.125, plus all fees that are collected per block. And if we take an average per block per day, we can get to an estimation of how much transaction fees Bitcoin miners are earning. So what we can see is that throughout October up until December, the average percentage of the block reward, which was constituted by transaction fees, is around 3.7%. The yellow chart moves wildly up and down. This is mostly driven by demand for block space, which can go beyond financial transactions. There are financial transaction related demand use cases for block space. For example, it could be increased activities by exchanges, and that could be driven by users of Bitcoin, interest in Bitcoin, institutional adoption of Bitcoin. And then there are non-standard demands, for example, runes mints, meta protocols, etc. And given the nature of this being highly unpredictable, transaction fees tend to move a lot. So far in December, average fees collected per block per day is around 0.1 Bitcoin, which is on par with November, but compared to Bitcoin's lifetime average, which is 0.34 Bitcoin per block per day, that's 70% below. So what we can see here is, yes, Bitcoin is on a tear, but the different constituents of hash price, which also affect mining economics more generally, is telling us a different story. On the one hand, difficulty is increasing and is at an all-time high, and we're seeing that transaction fees are relatively low compared to what we've seen over Bitcoin's lifetime on average.
Can I ask a question here, Kaan? When I look at this and you talk about that, you say the averages. Uh, can you say the averages again of the fees and the rewards? I think it
Yeah.
was point three. Yes, say that again.
So far in December, average fees collected per block per day is 0.1 Bitcoin. And
Okay.
in November, it was the same. But over Bitcoin's whole lifetime since inception, this is around 0.34 Bitcoin per block per
Okay.
day.
So the question I have is, do you think that that trend in Bitcoin will continue, even if that reward, even if that, that amount in Bitcoin continues to be more in fiat? That would kind of does that make sense, or is that like, or does that not make sense?
It's an interesting question. And this relates to the fact that a Bitcoin miner's revenue can be denominated in both USD terms and in Bitcoin terms.
Yeah.
Um, on the one hand, yes, there is the exchange rate effect between the US dollar and Bitcoin, in that you may be earning less Bitcoin denominated fees, but they may equate to ever more increasing US dollar denominated fees simply because of the increasing price of Bitcoin in US dollar terms. So it depends on what your goals are as a company. If you want to maximize the amount of Bitcoin that you're collecting and producing, obviously the more Bitcoin that's paid in transaction fees, the better for you. Or if you're taking a different lens and you're looking at your business through US dollar denominated revenues, everything's calculated in US dollars. You also have US dollar denominated liabilities and payables. You may find that this is just part of the course. So we're yet to see. It's an open question as to how transaction fees evolve over time, but we do expect the volatility of transaction fees to become an ever more important aspect of mining for mining companies to understand and observe, and also the changing nature between the block subsidy and the proportion of transaction fees that constitute the overall block reward as we move through halving cycles, and the block reward continues to get cut in half every 4 years or so. So it's an open question, but I think it's an important trend to observe and keep track of.
Yeah, thanks for clarifying that. I just because it almost sounds negative or bearish the way these numbers. You have a tenth of a Bitcoin as opposed to a third of a Bitcoin, but it's also like if you're mining and you're back in 2020 and Bitcoin's at $3,000 and you get a third, so yeah, you get $1,000 as opposed to getting point 0.1 today, where it would be about $10,000. You're actually getting more in fiat. So depending upon how you pay your OPEX, or as you've said, depending on what your strategy is, if you are trying to stack more Bitcoin and keep a treasury, which is obviously the thing to do today. Anyways, I just wanted to kind of call that out because it is interesting, depending upon your mining strategy, how you'll see the positives and negatives potentially of that.
Absolutely. And before we move on, I'll conclude by saying that right now, as we can see, is the block subsidy constitutes an overwhelming proportion of the overall block reward, upwards of 90-95%, whereas transaction fees tend to oscillate, but they usually account for around 3, 4, 5% of the overall block reward. So a miner's revenue is much more sensitive to the block subsidy versus transaction fees, which means that the block subsidy is really what should be top of mind right now. But like I said, as we progress through halving cycles, that relationship may evolve, and it's important to be aware of this aspect. All right, so yeah, exactly. So now we showcase transaction fees in US dollar terms. In US dollar terms, fees totaled 37 million in November, 45 million in October, and throughout the summer from July to September is around 20 million. So the big picture observation that we see here is that in the 7 months post-halving, fees have been much lower compared to the pre-halving average fees that were being collected. So transaction fees continue to be relatively low, and we'll see how that evolves. It's an open question. Okay, now moving on to ASICs, let's talk about some hardware. So taking a look at our hash cost table. Last time, Jarrett, you and I went over this visual in detail. Just to remind our audience, what we're looking at here is essentially a break-even table across 2 dimensions. On the one hand, we have our electricity cost, which is the primary driver of a Bitcoin mining operation's operating expenses. And this is denominated in cents per kilowatt hours. So this is at the very top. We have both US dollar denominated cents, and also we've applied the exchange rate for our Canadian friends to keep track of as well. The second dimension is our efficiency, which measures the joules, the amount of electricity being used to generate a certain amount of cryptographic hashes from a particular ASIC model. Given these 2 data points, we can compute how much it would cost to operate a particular machine at a specific power price and with a particular efficiency level. Now, once we have our current hash price, which is $63.50 right now, we can then come up with a curve and see at what point it would rationally make sense for us to shut down our miner, because the revenue we generate doesn't surpass the costs that we're incurring to operate the machine, and vice versa. That's essentially, in summary, what this chart is showing us. Now, last time we met, Jarrett, hash price was at around $60 to $61. Currently, it's at 63. So let's see how much of a difference that creates when it comes to the movement for this hash cost curve. So taking a look, this might be a little underwhelming, but we can see that there is a marginal increase, right? The curve is slightly moving upwards. The green space is increasing marginally, slightly, which means that there's more room to breathe. We can incur more power costs, or vice versa, we can run relatively worse efficiencies of machines and still be able to generate enough revenue to justify operating these machines. So what we see here is that, yes, Bitcoin is on a tear. We've hit major milestones, $100,000, $108,000. We're marking all-time highs. At the same time, other factors which influence mining economics overall, which is hash price, are also going in the other direction. Mining difficulty continues to increase, transaction fees are relatively low, and the end result is that hash price has improved, but ever so slightly. We are seeing a relative increase, but just one tick.
Yeah. Marginal improvement was the way to put this slide together for sure. Because when you see, and you've already shown the price, but I think last time we met, I don't know where price was, maybe because it really kind of took off after it literally actually after we recorded in the next 72 hours, the price really went. I think we had that Thursday or Friday that was kind of like the God candle where it went up 10% and more than 10K in a day. So I think the price was probably around 65 to 68 when we last recorded. To know that it's
Correct.
maybe gone from 68 ish, and I'm just throwing that number out, to all the way to 108 in the last 24 hours, which is a pretty gigantic leap, to then only see marginal improvement of hash price really does tell you that, the hash rate is growing exponentially. And just to call that out, something you and I spoke about off mic here, and it's on our X. If you're watching on X, you can scroll down. We just reshared it from Block Space, and Will Foxley he broke the story. But there's a Chinese car company that has 32 exahash online, and they're one of the biggest now publicly traded companies to have that much up online. So seemingly, I think this year, and we're going to get into this, I don't want to spill the beans too much, but seemingly people are going to come out of the woodwork over the next 12 months with hash, and they're just going to have it up online, whether it's a private company. And I think I'm pretty bullish on sovereign nations starting to really see Bitcoin mining as something good, not only financially, but also for their energy grids. So anyways, yeah.
Absolutely. And we will get further into some of the effects between Bitcoin price action and mining markets overall, and some of the trends that we're observing here at Luxor. And it goes back to what we talked about in our previous episode, Jarrett, is that it's not all about Bitcoin price. It's really about hash price, which is the true way to measure how mining economics are trending, because it takes into account various other factors which influence the profitability of a mining operation beyond just Bitcoin's price. And we essentially see this effect in this break-even table. Okay, moving on. So throughout December, what are we seeing in the hardware market? This is data collected from Luxor's ASIC trading desk. And big picture observation, 2 data points stand out. The first is we are seeing significant demand for the S19 series still, specifically the S19J Pro. And as before, we're seeing quite consistent and steady demand for the new generations of machines, specifically the S21 series and the S21 Pro model. Now, last time we talked about what's most important when it comes to making the ASIC purchase decision, and that is return on invested capital, i.e. the payback period. So this is a way for us to measure how long it would take for us to recoup the initial capital expenditure that we invest in purchasing ASIC machines, plugging them in, hashing them, generating revenue, and basically paying off the full amount that we initially incurred as an expense. At that point, we can then start to be in the green. We can start to make profits. So what we've seen is hash price has improved slightly compared to the prior month. We went from 60 to 63.5. At the same time, the way that this reflects on payback periods is that payback periods have slightly diminished. They've become a little bit shorter. Last time you and I met, Jarrett, the 21 series, these are new machines, by the way, they entail a payback period of just around 2 years. And now it's 1.9, 1.6, around that area. So we see just a little slight reduction. Compared to the older generations of machines, the S19 series specifically, what we were seeing was the S19 series had a payback period which was around half that of the new gens, just under 1 year. And the same thing applies here. We've seen a slight reduction in payback periods for the 19 series. We've also seen a little bit of adjustment as well. The XP stood out last time, and it was highly in demand throughout October and November. That was by far the largest amount of trade volume that we were seeing, but now it's shifted over to the S19J Pro. And there may be other reasons, but one reason is because prices for these machines are also quite volatile as well, which is a significant determinant in the payback period calculation. So as prices move, hash price is also moving. There's a lot of different factors which influence this single number, the payback period, which we can look at. But so far, what we're seeing is that payback periods are getting a little bit better. ASICs are becoming relatively more attractive to purchase, specifically the 19 series.
Yeah, I remember after our last episode, that was something that people spoke about. I spoke to a couple of people internally about at Compass, and I spoke to some other, even just some clients that were kind of interested, and they were trying to wrap their head around the mining economics, because that was just really quite fascinating that the payback period was so much quicker. Obviously, it has to really do with the sticker. The sticker price is just so much less. Not that the efficiency of the machine is maybe better, obviously from the J Pros. So yeah, this is, for me, looking at this from 30,000 feet. This is, if I'm new to mining, or even if I've been in mining, this slide and probably the next slide, which looks like if you want to go to, these just are just alpha that you don't really see in other places in the mining industry. So yeah, love it.
Absolutely. And our main goal here, Jarrett, like you and I said when we first started the series, is to empower the community with being able to make data-driven decisions and to showcase concepts that apply generally, and fundamental principles which we can use to make better decisions when it comes to participating in Bitcoin mining. And of course, ASIC purchases being a pivotal aspect of the overall operations. And we'll get into another factor as well towards the end of this section, which I think will be quite interesting.
Nick H says King Khan. I think I want to call that out.
All right. So we've talked about the demand side. Now let's look at what's happening potentially on the supply side. One thing that we like to keep track of with our trading desk is bid-ask spreads. These are the differences between the two prices that the demand and supply side in our ASIC trading marketplace posts when communicating together. Now, what we're seeing throughout the past few months is, specifically for the S19 series, is that bid-ask spreads have widened, which means that there is a relative disconnect between what demand wants to pay versus what supply is willing to take in terms of pricing for these ASIC machines. So if we take a look at the J Pro, for example, in October, we had a bid-ask spread of 13%. In November, this was 27%, which is a 14% increase. And in December, this was a 51% spread, which is a 37% increase, which means that these machines are actively being repriced. Demand and supply are coming to meet in our marketplace, and they're negotiating as to what the fair market clearing price for these machines should be. And the bid-ask spread changes is one way that this is being expressed.
Yeah, so just looking at the J Pro, if we go from November to December, walk me through this. So the bid in November is at $2.25. It's actually the same bid in December. However, the ask has changed. So the sellers are still saying, can you explain this to me, as if I'm trying to sell you the S19J Pro in November as opposed to December? What's happening here?
Absolutely. So what's happening is, between November and December, the bids are staying relatively the same. So the demand side, potential purchasers of these machines are willing to pay the same price for these machines, which is around
225 per terahash. Okay.
Exactly, dollars per terahash. Whereas the ask side, which is the supply side, is saying, wait a minute, I want more. I want a higher price. I think that a fair price for this machine, for me to give it to you, is now higher. So this is why the spread has widened. The spread between bid and ask, i.e. between demand and supply, is increasing, which means that there is becoming more of a negotiation between demand and supply. Demand is willing to pay the same price, but supply is asking for a higher price, which increases the spread. And there are many factors which could drive this, but one is that we've seen that there's an increased demand for the J Pros, right? If we go back to our buy side demand here for December 2024, the J Pros stand out alongside the 21 Pro. Now, if we take a look at, if I go on to my next chart, we might get some indication as to what's happening with the supply side. Perhaps supply is becoming relatively more tight as more machines get bought and move around. Maybe stockpiles of J Pros are running out. Maybe the locations that people want these from are changing. So because of this, there's a repricing that's taking place right now. And we can see this in our pricing chart as well. If we take a look, what this chart shows us is historical trading prices for used ASICs. We have the S19 series. We also have the M30S Plus and the M30S Plus Plus. Now, if we focus on the section between October to December 2024 at the right-hand side of this chart, we can see that there is a turning point. Something changed here. There was a downward trend for pricing for all of these machines, but all of a sudden there's an uptrend, there's an uptick. And the reason is because, on the one hand, there's a significant amount of demand for these machines based off of mining economics and their current prices, which means that right now they're attractive to buy. At the same time, supply may be relatively constrained or simply running out. And because of this, we see a reflection of increased prices and wider bid-ask spreads. So demand and supply are actively engaging in negotiations, and we're seeing how some of these conclusions are expressed in bid-ask spreads and in trading prices.
Yeah, can you actually go back to the previous slide? So in November and December for the for the J Pro 225, 225, I'm assuming if Bitcoin continues to grow, obviously I think difficulty is going to continue to grow. So maybe the hash price doesn't explode. But the story in my head is that by January, next time we meet for mining metrics, and we have, if you show this slide, I'm assuming it comes up from 225. Is that unreasonable?
No, that's a great point, because what's happening here is if the willingness to pay remains the same, but the ask is higher and the spread between them has increased, at some point this is going to be renegotiated to a point where the market starts to clear again. And what's likely is that the bid is going to start to move up. So that's what we may expect to see. On the other hand, depending on other factors which go into demand and supply, there may be some other way that this is reflected in prices as well. But yes, that is correct, because what we're seeing is that prices are increasing. So the point at which the market clears, the point at which supply is convinced to sell and move these machines, is at higher price points, which has been happening throughout October to December.
Great. Awesome. Yeah, I'm excited to check back in on that just to see, because one of the things that you and I would like to do is on every mining metric, make sure we show a little bit of where we've been since we started the show. By starting the show in November of 2024, I think by November of 2025, we're going to be able to look back and see some pretty cool trends based on miner, how many people wanted a J Pro? What was the hash price? Looking at the cost curve, I'm excited for that to hopefully continue to move more up and to the right as that wave moves, right? Let's let more people with some less efficient machines and maybe where they don't have the best power be able to get online and get some hash.
Absolutely. We want as much green space as possible. We want as many hashes out there in the world as possible. So before we move on to our next section, I want to introduce another dimension when it comes to making the ASIC purchase decision, and that is around the impact of logistics and shipping being accounted and baked into our payback period calculation. Last time we met, Jarrett, you asked a good question around ASICs, and we had a good discussion around what really matters is return on invested capital, i.e. payback period. How quickly can I recoup the initial amount of money I spend in buying these machines, plugging them in, hashing them, and generating revenue? Another dimension to further complicate the ASIC purchase decision is that of shipping and logistics. So taking a look here, I put together a chart which shows two of the popular models that we just saw for December. the first being the S21 Pro and the second being the S19J Pro. Now, if I go back just to remind ourselves of the payback periods, the S21 Pro entails a payback period of around just over 1.5 years. The S19J Pro, just around 1 year. Now, this is assuming that you receive the machine without any costs associated when it comes to moving it, transporting it, perhaps importing it. So this doesn't take into account anything to do with logistics, shipping, import duties, excise duties, etc. But it's really important to account for this when obtaining a payback period calculation. And the reason is because it can have a significant impact on the payback period that you truly face. So if these costs aren't baked in and accounted for, and at least observed or tested to some extent, a mining operation may find that what looked to be a sensible ASIC purchase decision actually turns out to be inoptimal, and the return profile that they expected to get may not be the case. So to demonstrate this, let's take a look at our two cases. What I first did was I obtained from our logistics division at Luxor estimated shipping costs for two scenarios, one being US domestic and the second being international. For example, if I were to have an S21 Pro delivered to a Compass mining facility, let's say located in Ohio, that entails a certain cost, which is to do with US domestic shipping. And the marginal impact it has on my payback period is quite low. In fact, it's negligible. We saw that just vanilla payback was 1.65, and with US domestic shipping, the very left bar that we see, it's 1.66. So there's barely an effect. It probably costs around $50 or so just to have one unit sent over to Ohio within somewhere in the US. Now, if I were to do that for an international payment, here we see a little bit of a difference. Specifically with the S21 Pro, per unit, we see an additional cost of 5%. We see an additional increase in our payback period of 5% after accounting for international shipping costs. So there's a slight increase in the payback period. The investment thesis has slightly diminished because we're now accounting for expenses that we would realistically face if we were to actually receive this machine and plug it in and hash it out. What's very interesting is if we repeat the same exercise for the S19J Pro, we see a massive difference, a significant difference between the US domestic shipping scenario and the international scenario. So previously we saw that our payback period was just under a year. It was 0.9. With US domestic shipping, if I were to send a J Pro to a Compass facility in Ohio, I would get a payback period of around 1 year. If I wanted to send that same J Pro to Cyprus, it would actually increase my payback period by half a year, which is a significant factor to be aware of, because that may change my investment decision from something that I want to do to something that I shouldn't be doing. So I'll pause here for a minute. Do you have any questions?
Yeah, first of all, I love that you chose Cyprus. I wonder why. And then I look at this, and the thing that comes to my mind, this just must be because the S21 is so much more expensive than the S19. Therefore, as a percentage of it, if you add a $50, and I'm using the domestic, right? But if, even if it's $150, when you add that to the S21 as a percent of the overall value of the hardware or the price of the hardware, it's going to be negligible, as opposed to the, S19J Pro, which is a little bit of an older generation model. It's just going to be so much more of a percent, which is then going to allow, they're going to, increase it by 6 months as opposed to 1 year. So am I on the right line there? And obviously Cyprus, for those that don't know, beautiful country, over in the Mediterranean, as far as I know. I only know it through Wikipedia, but it looks beautiful to me. Is that about accurate? Just because of it, we're talking about percents?
Precisely. That's precisely correct. And the reason is because when you denominate these ASIC prices in dollars per terahash, just like you said, the 21 Pro is much higher in value. So if I were to pay a nominal fee for an S21 Pro, it would be in the range of thousands of dollars per unit. So the additional expense that I incur for shipping on top of that as a proportion is insignificant. It's very low as a percentage. But compare that to the S19 in dollars per terahash terms, it's significantly cheaper than the newer generation machine. But on a nominal term, when you tack on the costs associated with shipping, all of a sudden the actual cost that you're paying, the overall cost, has doubled. So that's exactly right. That's why we see this difference, which shows us again that there's a trade-off between older generation machines and newer generation machines, and the sensitivities around how additional costs associated with practically receiving them may affect the return profile for certain ASIC investment decisions.
Yeah, I love that. And I think that this is an important one for us to consider and for everyone listening who's in the Bitcoin mining industry, because the next time we have the next mining metric show, this is a monthly show, will actually be on January 15th. January, the first day of January happens to fall on a Wednesday, and we always do the third Wednesday of the month at noon Eastern time. And the reason why I say this, that's going to be on the 15th, is the 20th will be the inauguration of the next president of the United States, Donald Trump. And he has talked a lot about tariffs and how tariffs could impact Bitcoin mining industry. We don't know yet, but if certain tariffs are put into place, this particular slide, is maybe something we really dive into in February. We won't really know on the next mining metric show, because it's going to be 5 days before the inauguration. He's just going to, get into office and then start to make his geopolitical economic decisions. But by mid-February, when we have that show, we may add a slide that has a little asterisk that says tariffs, right? Where then, especially on a secondary marketplace, certain miners just may become more valuable as people start to do this type of math. So yeah.
Exactly. Location, location, location. Last time we talked about how the ASIC purchase decision is not about always getting the latest and greatest. It's about getting the right computer at the right price at the right time based on hash price environment. An additional dimension to further complicate this decision is location. It matters where your mining equipment is coming from, where it's moving to, because that may have a significant impact on your overall return profile. So with that being said, we'll now move on to the next section, public markets. Okay, this is an interesting chart that our derivatives team put together. Our director in our derivatives desk, Ben Harper, put this together in one of our recent analysis pieces. And this demonstrates what we've been talking about throughout this episode, Jarrett, and that is the divergence between Bitcoin's price action and mining markets more generally. We keep saying this. Bitcoin is on a tear. It's ripping. It's at all-time highs. It keeps breaking new ground, which is great. It's exciting. It's fun. At the same time, though, the mining industry and mining operations are having a little bit of a different experience. Why is that? The reason is because, we always come back to this, is mining economics not only depends on Bitcoin price, but it depends on other factors as well, which is captured by hash price. So that's really the metric that matters, not just price action, but hash price overall, the revenue that a miner can generate for the commodity which they produce, which is cryptographic computing, securing the Bitcoin network. What this chart shows us is that despite the increase in Bitcoin price and hash price, record high network difficulty and historically low transaction fees post-halving continue to weigh on mining economics. This has resulted in a divergence between Bitcoin's price action and overall mining markets. So the two other lines that we're showing here, the first is Bitcoin price, obviously. And this data is of the end of November. So it's a little incomplete, but it still tells us the main observation, which is that there is this divergence taking place. The second is our hash rate index crypto mining index. This is a index that we created at Luxor, which tracks the Bitcoin mining industry overall. It includes Bitcoin mining companies, it includes manufacturers and ancillary companies that are associated with the Bitcoin mining industry. So it's a nice catch-all way for us to understand how the publicly traded mining market is trending. And then the third is hash price. Obviously, we know that hash price is getting depressed. We just moved from, we had the most recent halving cycle in April, which cut hash price essentially in half, and then it's been repricing ever since. So the moral of the story is, although Bitcoin markets are at an all-time high, mining markets aren't necessarily, and they have yet to catch up. So I'll pause here for a minute. Any questions on this?
No, I mean, I want this to continue. I want to see that hash price bounce a little bit, because when you look back and you see there's almost like 3 peaks, and I don't know if everyone can zoom in all the way, but yeah, that was in September of 21. And if you were in Bitcoin or Bitcoin mining in September of 21, that was a good time. But it's interesting to see it drop, by orders of magnitude to where it is today. So hopefully by the next time we meet in January, we start to see that continue to trend up. The hash price being the red line in the bottom there. So yeah, it's nothing. It is interesting though. And I think that is the Machiavellian economics behind Bitcoin mining, that, as Rob Warren said in his book, The Bitcoin Miner's Almanac, and I will totally shill that. It's a great book. Everyone should go read. He said, it's not just a buy and hold. We're not just buying Bitcoin and holding. We need to constantly be out there innovating and finding new solutions to, honestly, problems that pop up every day, to make sure that we are staying profitable.
Absolutely. Mining is that beautiful game. So moving on to our next slide here, an interesting trend that we've seen recently is that publicly traded Bitcoin mining companies are tapping into capital markets a la MicroStrategy and the convertible notes issuance playbook. So we've seen that mining economics have improved slightly over time as of recent. But if we zoom out and take a look at the big picture, what we're seeing is that compared to Bitcoin, mining markets are lagging somewhat. Hash price is depressed. The network is as competitive as it's ever been. Transaction fees are a little low and slow. So public miners are finding alternative ways and alternative strategies to essentially expand their businesses. And the way they have been doing this recently is they've been issuing convertible notes, just like MicroStrategy has, in an effort to either purchase Bitcoin or to expand their operations, use the proceeds for expansion by buying hardware, paying down debt, etc. There are many use cases for which these funds could be put towards, mainly being Bitcoin purchases and expanding operations. So we are keeping track of this. We think that it's an interesting observation to be aware of, because Bitcoin mining companies are now also tapping into this demand from the capital markets for exposure to Bitcoin, alternative exposures to Bitcoin, and also with specific pools of capital that may or may not be constrained to get access to Bitcoin exposure. So this is a smart way of essentially meeting that demand through interesting use cases of financial instruments. Before we move on to our next section, we always like to put this chart together. This chart shows what selling hash rate forward would have looked like throughout the month of November, which is the most recent full month of hash rate forwards market trading activity that we've seen. In essence, selling forward tends to earn more than spot when it comes to Bitcoin production. Now, hindsight is always 2020. The big observation for us to understand here is that it's important to think about hedging and to consider it as part of a mining operations overall strategy, because what it tends to do is it tends to smooth out revenues, increase valuations, and lower the cost of capital, which is just another way for Bitcoin mining companies to continue to grow in a healthy and sustainable fashion. So it provides another way to tap into pools of capital which are looking to get exposure to Bitcoin. And this can be done by hedging some part of your Bitcoin production or your US dollar denominated revenues, which tends to make a more attractive case for investments. All right, moving on to our final section, forward hash rate markets. So I wanted to put this together because what we've seen throughout November and December was obviously a massive rally in Bitcoin price. And this chart quite nicely shows us the effect on the forward curve and what this means for hash rate derivatives. What we're seeing here is the forward curve, the hash price forward curve, both denominated in US dollars and in Bitcoin, and how it's evolved throughout the month of October as Bitcoin continued to rally up. The big observation is that the US dollar denominated curve is moving upwards, which means that hash price is increasing. The Bitcoin denominated curve is going down, which means that Bitcoin denominated hash price is decreasing. And also the gap between the two curves is widening, which is an indicator to Bitcoin's price action. This captures the exchange rate effect between the US dollar and Bitcoin's price, because that is the only difference between US dollar denominated hash price and Bitcoin denominated hash price. So what this chart is showing is throughout November, Bitcoin price action was quite significant and up to the right.
This is that's quite the chart because it's so dynamic the way it moves. And so should we, in theory, continue to probably see that divergence happen? Would you think? That seems to be the trend.
Yes, that is a good question. I think so. And the reason is because the only difference between the US denominated hash price forward curve and the Bitcoin denominated curve is the exchange rate between the US dollar and Bitcoin price, i.e., Bitcoin's price in US dollars. So if that continues to go up, we can see that this gap would start to widen. So now taking a look at some scenarios, it's interesting to understand that November was a pretty significant month because of Bitcoin's significant price action. We had an interesting outcome. In US dollar denominated hash rate markets, November hash rate settled higher than traded in the prior 5 months, which meant that if you were long hash price, if you were buying these contracts, you would have made a return. Versus if you were a hedger, if you had sold your hash rate forward, you would have actually locked in a lower hash price from before versus where November actually settled. So as Bitcoin price goes up, if you're hedging in US dollar denominated terms and you're locking into a specific hash price, you're missing out on the difference between where spot hash price is, which is higher, versus your locked in hash price. And that's why we see across the board when we look at USD denominated chart, which is about to come up right now, it's red all across the board. So whether you sold forward 5 months ago, 4, 3, 2 months ago, you would have been better off basically being exposed to spot hash price. Of course, this is in hindsight. Conversely, in Bitcoin denominated hash rate markets, we see the exact opposite. So in Bitcoin production terms, outcomes based on hedge timing were less varied, but they had a positive production delta. So the Bitcoin denominated hash price fell throughout November. Had you sold forward ahead of time, whether it was 5, 4, 3, 2, 1 month ahead, you would have locked in a higher Bitcoin denominated hash price, which means that you would have ended up with producing more Bitcoin, which is why when we take a look at our previous chart as well in the Pubco hypothetical scenario, this is why we still see that. So even though in US dollar terms, it looks as if hedging would have resulted in negative outcomes for revenue, US dollar denominated revenue, in Bitcoin production terms, you still would have locked in a higher Bitcoin denominated hash price, which would have given you more Bitcoin at the end of the day. Now let's get into some forward-looking analysis. Last time we talked about this, Jarrett. What we can
Actually,
do now. Yep.
Kaan, just before you go there, I want to shout out to anyone who's watching. If you have any questions, start to leave comments, and we can start to get those questions ready as we get towards the end. So that we will have some questions for Kaan as we get closer to the end. Just wanted to call that out. Thanks.
Awesome. So now that we've taken a look at both contracts, very simply, if we use the two contracts by dividing the US dollar contract values with the Bitcoin contract values, we can obtain implied Bitcoin price expectations, which were expressed by the market throughout the November trading session. What we're going to realize very quickly here is, let's say I take a look at the 2nd of December column and the sell value at the very bottom right, which corresponds to April 2025 row. The interpretation here is that on the 2nd of December, what the forward market was expressing in terms of its opinion on forward-looking Bitcoin price is that the market expected Bitcoin to be around 101,000, just under 102,000 by April 2025. Conversely, 100,000 by January 2025. Now, obviously, we know that we've surpassed this milestone, which means that we're ahead of schedule. Christmas came early. But at the same time, it goes to show that the opinion being expressed by the forward market is only an indicator for us to observe as an additional data point in understanding what the overall sentiment is and the information that's being baked into market through these derivative contracts being traded.
Yeah, I remember when you shared this in our last episode in November, and it just felt super bearish.
Mm-hmm.
But obviously, like I said, when that last episode, Bitcoin was maybe around 68,
Mm-hmm.
which was still lower than the last bull run's all-time high. So maybe things were seeming a little bit more bearish in the market. So will be interesting to maybe even compare some of these numbers in January when we come back, where we're going to be 5 days away from 5 days before Trump's inauguration, a whole new year, just a different place. I have seen some sell off in Bitcoin and crypto from just friends who are just trying to, or donations, right? As they're thinking about, it's the end of the year. How do I lower my tax exposure? How do I, balance some books? So December, out of all the months of October, November, and December, is normally one of the most bearish months out of those three. So hopefully in January we start to see that change, and I will be interested to see what January 2025, that should look different next, in theory, by next episode.
Mm-hmm, mm-hmm. Yeah, great point. So now, once I move on, before we do, I just want to point out the color scale that we see. So from the 4th of November to the 2nd of December, we see the color scale move from red to green, which means that throughout the month, over time, Bitcoin price expectations increased, right? We're moving upwards in terms of what the market thinks is going to happen in the future. The reason I point this out is because we can now combine this with some other data points that we're seeing. For example, we know that Bitcoin prices were going up. Bitcoin price expectations were upward throughout the month. At the same time, US denominated hash price contracts were trading in backwardation. So if I go back to my forward curve, I can see that the slope of the curve is downward looking, which means that its hash price is expected to go down in the future. Both these points together point to the fact that the market's expectations around network difficulty and hash rate would actually outpace Bitcoin price growth. So what we're saying is, yes, Bitcoin price is expected to increase, but what the market is saying is we expect hash price to actually suffer and go down in the future, because network difficulty, i.e. hash rate, and transaction fees will counteract Bitcoin's positive effect on hash price and pull hash price down, which means that competition is going to become more fierce. So it's another interesting data point that we can infer from what the forward market is telling us.
Yeah, that seems to be continuing with the trend, as you called out, because it feels like even though Bitcoin is ripping, the hash price has only moved marginally since over the last 6 to 8 weeks, even though the Bitcoin price has gone up 40%, 45% or something like that. So
exactly. And finally, we can also make some implied calculations around transaction network difficulty and overall global network hash rate as well. In this figure, we assume a 0.15 Bitcoin per block transaction fee on the 4th of November. and 0.10 on the 2nd of December, which is the average that we've seen throughout the month of December so far. And what we can take out from this simplified analysis is that during November trading, end of year hash rate expectations increased. They rose by around 25 exahashes, which we can see by looking at the January 2025 row and comparing 787 versus 761. And then Q1 2025 expectations for hash rate rose by around 40 exahash as well, which we can see for April 2025. We went from 815 at the beginning of the month to by the end of the month, the forward market was saying to us, we expect hash rate to be around 844 exahashes by April 2025. To contextualize this, the current 7-day simple moving average for a global network hash rate is just under 790 exahashes per second.
Crazy.
So, with that being said, I want to close off this section with another concept that we have recently observed and demonstrated with our derivatives desk in a blog post that we wrote for Hash Rate Index, and that is to do with the forward hash price and its capability to be used as a forecasting tool, as an estimator for future spot hash price. Essentially, the observation that we see is that forward hash price is a strategic advantage. And the reason is because in mining, spot hash price is an indicator for immediate revenue generation. But where it has a shortcoming is when it's used as a forecasting tool. And this is because of the nature of hash rate as a non-storable commodity. What we mean by this is, unlike storable commodities such as oil or Bitcoin, for example, hash rate can't be stored. It can't be used and deferred for future use. It's comparable to electricity. It's generated and used at the exact same time instantaneously, which makes its spot price, i.e. hash price, a poor predictor for future revenues. Forward hash price markets, however, incorporate anticipated changes in network difficulty and transaction fees, which provides a more accurate forecast of future spot hash price, where spot hash price may go in future. So we did an analysis and we compared our forecasting accuracy between the forward hash price and the spot hash price versus actual settlement hash prices throughout the months from December 2023 up until the beginning of December 2024, so covering a year's worth of trading data. And what we see is that the forward hash price predictions are 80% closer to actual outcomes versus spot hash price, which underscores the advantage of observing the forward hash rate market. If the audience wants to get more detail on how we did this calculation and the underlying reasons behind hash rate and Bitcoin as storable and non-storable commodities, I would direct you to our hash rate index blog post, which talks about this in detail. But again, we think this is one piece of insight, which is especially important for professional mining companies to be aware of, because it shows that forward markets matter and the level of information and the type of information that they bring to the table goes beyond what we can obtain from the spot hash price markets.
Yeah, and what we'll do if you're watching this on YouTube, because we'll take this recording and we'll throw it up on YouTube. If you're watching this, we will leave that blog post in the episode's description. So go check that out. And what you guys can do, if someone's listening at Luxor right now, they can go on to the original post or their post. It'd be better if you went to the original live from Compass and just put in that blog post. So that way people can go and find it.
Absolutely. And with that being said, here's what our forward curve looks like right now. We're pricing in an average hash price of just over $61 per petahash per second per day over the next 6 months. And as we come to a conclusion, the big question that I would leave for Jarrett and our audience is, will Bitcoin price keep up with network hash rate, or will we continue to see the divergence between Bitcoin and mining markets overall?
That's the $2.12 trillion question now. I don't even know where the market cap is, but I'm hoping that Bitcoin can continue. My hope is that Bitcoin can continue to outpace the network, because if it doesn't, while Bitcoiners are going to continue to rejoice, I think it's going to continue to be a little bit tighter than maybe miners would like it to be. So that's what we got. We have no questions in the hopper. So I guess what I'd like to do is I'd like to thank you for hopping on today. And, next time we see everyone, I've said the date out loud. I'll say it again, January 15th at 12 p.m. Eastern time. We'll be back for another edition of Mining Metrics. And Kaan, thank you so much for joining all the way from Cyprus. And I hope you have safe travels back to Canada. And I hope you have a good holiday. For everyone else watching, please have a good holiday. It's the holiday time, holiday spirit. Try not to orange pill too many people at your holiday dinners. Let's all be grateful for what we have. And Kaan, thank you once again for joining.
Likewise. Thanks so much, Jarrett. Take care.